Good evening and welcome to the Silicon Valley Entrepreneur, a series of conversations with startup founders and their investors on what it takes to build a viable, fundable company. I'm Chris Gill, President and CEO of SVAs, the Silicon Valley Association of Startup Entrepreneurs, the largest and fastest growing not-for-profit for entrepreneurs in Silicon Valley. This week I'll be interviewing Jeff Clavier, angel and founder of Softech Venture Capital, and John Cornwell, a board member of Sandhill Angels. So Jeff and John, good to see you here. Thank you for coming along and welcome to the Silicon Valley Entrepreneur.
Thank you. Thanks.
Jeff, if I can start with you. Today we're going to be exploring trends in angel investing, particularly in light of the current economic climate. But to set the scene, can you give us a little bit about your background? How did you become an angel and what market sectors do you focus on?
So thanks for having me. I started by being an entrepreneur in France. I'm French, doing a startup in the financial services market that we sold to Reuters. Stayed for 7 years with them. Became a VC for them in the Reuters Greenhouse Fund for 4 years, from 2000 to 2004. And in 2004, decided to go on my own, invest my own money in this sort of new environment, new market, new generation of internet companies called Web 2.0. And I did about 20 plus angel investments on my own, and then raised a fund called Softech VC2 that I'm investing out of right now. It's a $12 million fund that has done 32 investments in the past 18 months.
Wow, I mean that's quite a lot of investment. So
I have been quite busy.
Yeah, you have. Okay, we'll come back to that, but John, can perhaps you give a sort of overview of, again, the same sort of thing?
Again, Chris, thanks for the invitation. I'm actually local. I grew up in Saratoga and was exposed to a lot of the 70s kind of Silicon Valley culture. I started off actually in software, surprisingly enough, and on the Apple II platform doing games and copy protection and some e-learning stuff. I went off to Berkeley, got a degree in medical biophysics, and that kind of put me more on the biotech track, and went to Genentech and Cell Genesis, which was a Mayfield-sponsored company, and was in the kind of the R&D side of things, and got an itch, went back to Berkeley, got an MBA, and also Columbia, got an MBA from there, and decided to formalize my angel investing. Back in when things started getting kind of fluffy in the late 90s, I was a rather naive angel investor. I operated on my own, invested in a couple startups of people that were colleagues. Some of them are still alive, surprisingly, 10 years later, but not exited. And the last few years, I've been working as an independent consultant and to biotech companies, and involved with a couple angel groups, specifically Sandhill Angels.
Okay, and what areas do you tend to focus on?
So I tend to focus in more life science, biopharma type deals, but there's some issues with some of the mechanics and the model for investing as a small investor in those companies. So I've also invested in software and some devices and some consumer plays. So just diversifying, or trying to.
Okay, so we'll definitely come back and explore some of that. But Jeff, if I can come back to you, and so you had a pretty active 2008. It sounds like. So what have you seen in 2008? And what happened from the good times then to what we're seeing now?
So first, in terms of investment strategy, what I do is do a lot of seed deals. So investing in the first round of companies, either as a lead, where I put together a syndicate, putting in anywhere from $750,000 to $1.5 million in a company. So those are sort of larger sort of seed deals that will see the company through a couple of years of runway, or just following those kinds of syndicates. And the approach I've taken is to invest in a number of companies to sort of, essentially if there is something interesting to me, like the founders, like the market, like the thesis, I will sort of take a shot and work with them to see whether it was worth it or not. And in those sort of good times, there was a lot, good times being like up until mid-2008. A lot of opportunities were up. 2-3 founder sort of type team getting together and going on, a typically advertising funded or advertising sort of revenue based social media, sort of media play. and those, got funded sometimes at pretty crazy valuations in a few cases, and it was all good. And obviously, when the market sort of started to turn down, a lot of those deals sort of stopped being funded. A lot of the casual angels, the people who were sort of putting money in those deals, 1 or 2 a year, just as their extra income sort of allowed them, basically retreated because of Wall Street sort of losing them a lot of their income and net worth, and it sort of left the market to organized angel groups or sort of pros, people who sort of invest a lot and are in the market still, with clearly lower valuations and extended sort of times it takes to actually run through the investment process.
Right.
So longer times and lower valuation is sort of the net result.
Okay. And for you, is this still a good time to be investing, or have you backed off?
There's two ways to look at it. One is, yes, I'm definitely in the market, and I believe that there will be extremely interesting companies being started and funded right now, because there is sort of a flight to quality, and there will be sort of measurably less funding happening. But the companies which will be funded in this market will have a better shot at actually doing something, I think, especially given that there's no other choice now than have a revenue component or focus on revenues, whereas in the past it was sort of not required by the people funding the next round to demonstrate, how your business model would sort of work. Clearly, what I have to do as well is help my existing portfolio to sort of survive in those challenging times, which has meant, going through the portfolio and figuring out with the CEOs, how much runway we had, how can we sort of extend the runway, raise a bit more money potentially, cut back, on expenses. So that means, unfortunately, having to sort of lay off some people, and really figure out how we can have at least a year or a year and a half of runway so that we don't have to raise money in this environment. Some companies that I have invested in maybe a year and a half ago had to go through a financing round, and I've been so far pretty happy or lucky or both to see a bunch of those companies essentially being funded for the next round in this environment. It's slower to close those rounds, and the valuations are not always what you would have expected or liked, but at least they get funded, they have a runway, and that's positive.
Okay, so that's interesting that Web 2.0 type companies, if we call them that just for the sake of it, basically using ad revenue as their business model, that's now completely gone, so they've got to be a bit more formal on a business model. So
it's broadly expected that online advertising will still be there and will still be around, and there will still be sort of measurable budgets available. However, a lot of those budgets will go to proven properties, and so for startups that would use ad networks as a mean to access advertising revenue, those have actually seen a drop of over 50 or 60% of the typical CPMs they're paying, and it's only going to drop further. And so you have to come up with alternative sort of sources of revenues. They may be subscription premiums, e-commerce revenue, anything really to sort of mitigate that risk. Otherwise, if you're only advertising based and don't have sort of direct relationships, that will be very tricky. And even direct relationships, you see a bunch of consolidations happening because advertisers just retreating. Automobile was a huge advertiser, or the automobile category. Finance was a huge advertiser, and they're both completely crumbling.
Right.
And so that's definitely that has a serious impact on the potential revenues of those companies. And so I wouldn't say that it's completely gone, but certainly something which is interesting but only advertising based will be challenged to find financing.
Okay, thanks for that, and we'll certainly come back to you.
Yeah.
So John, what's your take on how did 2008 pattern on the sorts of deals that you look at and come into Sandhill, and what do you think's happening now?
Well, I think one issue with again, I do typically life science deals. They tend to be longer term plays in terms of getting to break even, and they tend to be more expensive to get there. So, you know, there's some opportunities as well, as has been said. The valuation environment is better, but for companies that actually were fairly disciplined about setting valuations, and investors that were disciplined, trying to raise additional money right now is very, very difficult. I mean, there's a company I've been very involved with that we did about a $2.7 million A round in with a couple of angel groups and syndicated with some VCs. Had a nice $25 million term sheet, signed at about a 50% uptick. And it's very difficult to get any of those folks to come in and like actually complete that deal. So I've seen a lot of software deals that there's still an appetite for because they're capital efficient, and you can tell very quickly. Life science, and you can actually argue that maybe life science deals are not good angel deals because it might take you 5-6 years before you figure out whether you got something. Where Web 2.0, you know, you can throw $1 million in, and you know in a year whether you got traction. But there are some positives. One is, you know, again, the baseline noise has been cleaned out. The deals that are there are higher quality. With industry in general trimming down, there's some very talented individuals who are available who never would have gone to a startup. So I think there's some real opportunities. And if you look back at 2000, there were some great companies founded back then. There's always great companies around. So I think there's some real opportunities right now. I think when the panic ends and people step back, I think they'll start investing again. I think the cash flows will start, the investment flows will start picking up mid-year. That's my my hope.
Okay. Are there any particular of the macro trends that you believe affect any of the groups, like enterprise software, like the medical instrumentation? Is there anything that?
Well, obviously, it's all about exits, right? And you know, software deals have usually been acquisitions, and it's not clear what that market's going to look like. Biotech type deals have been IPOs and also acquisitions. IPOs are, I mean, who knows when that's going to come back? It may never, you know, in terms of being a relevant exit for the kinds of deals that I'm involved in. But, and there's also concerns about reimbursement and healthcare costs in general. There's some very large societal issues that, you know, some people say the party's over, you know, and you can't just pay, you know, $60,000, $70,000 a year for a drug that has some marginal improvement. So I don't know. It really is an interesting time to reflect on some of the macro things that really may change the fundamental business assumptions for early stage deals. Okay.
So Jeff said that he's staying and investing. He says this is a good time still.
Yeah.
For what you're seeing in Sandhill Angels, are you seeing still being an appetite for investment in Sandhill, or
oh, absolutely. No, we're still our deal flow has actually been almost dead. It's maybe varied 10% over the last couple of years. Surprisingly, you'd think that you'd see some change. We're still investing, and you know, I think the appetite for investing is that, you know, people are looking at some of these valuations. In some cases, there's companies that we blew off 8-9 months ago because we thought their valuations were out of line, but we liked the team and we liked the technology. We're seeing them come back around and very attractive valuations. So.
Okay. As we're on the topic of valuations, for the benefit of people watching, can you explain a little bit about the metrics of angel in investing and seed investing? Because what you do is you put in one lump of money once, and then you just have to watch what happens. Can you talk about that a little bit, and what makes sense to you to be a good deal?
It's actually a very black art where there's no real sort of, because when you invest at the seed stage, I'm not sure about medical devices, what you guys look at or what you have available to you, but typically the deal that comes to me will have, you know, a couple of people, maybe, you know, 2 or 3 founders and maybe 1 or 2 engineers who have most often built a prototype of a service that will sort of give you a good clue as to what they want to build for real. And they will present you with a plan that will be always with a very nice hockey stick, in year 5.
Isn't that amazing? It always goes.
It always goes to 100 million in year 5. It's sort of the reference.
Yeah.
But there's nothing you can actually, or most often there's nothing you can actually reference in terms of numbers or traction or anything to base a sort of decision on. So it's really, do I like the team? Do I think that this team has the right sort of chemicals in terms of talent, in terms of ability to work together, in terms of being able to face in this environment a very definitely changing times that will require to move from one strategy to the next. So it's sort of the team's ability that you will sort of invest first and foremost in, and then you will sort of figure out based on your experience, based on what you know the market is, based on what you know other people might pay for it, because angels typically always syndicate, and therefore once you're convinced, you have to convince other people who are sort of like you that this price is actually the right one. And so there will be sort of a few ranges that are sort of in the market, and you will sort of figure out whether there's a deal to be had between the price you're ready to pay and the expectations of the founders.
Okay, so as you can only put in this one shot, you don't have in the way that a VC has, maybe has 5 million put in and 10 million to keep going to maintain their equity share. So your equity gets diluted if there are subsequent rounds.
Sure.
How do you balance that in looking at the opportunity that you're seeing?
So what that means is that the initial investment that you put in the company that will be in this market, you're trying to sort of fund them for a couple of years of runway. The idea being that you want to see at least 12 to 18 months of pure execution where they only focus on the product,
right.
And then you pad that with 6 months of runway for fundraising, for the next round, and you hope that those 2 years of runway will sort of give them enough time and opportunities to prove their model, prove the traction, prove a bunch of things that will sort of get them to a nice valuation, nice
right.
uptake for the next round, which means that the dilution you will suffer from, with your initial investment is not that much or reasonable. It's just a strategy which I had to sort of default to because I don't have with my fund, enough money to go, all the way and preserve my pro rata, up until the last round.
Right.
And so that's a choice I've made. We'll see whether it was the right one or not in a few years.
Okay. So John, with the Sandhill Angels and a different type of investment, the ones that you're doing, you've already said that life sciences type products tend to be 4, 5, 6 years out. Enterprise software, I know the typical amounts that need to go in to make enterprise software stuff. So do you follow the same strategy that Jeff does? You put in an amount and you stand back and watch it ride, or do you try to maintain?
No, I mean, realistically, there's no way that, again, angel funds are essentially a pledge fund, and we don't have reserves either. Recently we've actually been in a position where we've needed to go in and actually do bridges behind our participation in A rounds to keep them moving along. No, that's for us. Our biggest risk isn't technology risk; it's funding risk because we don't have those deep pockets. We can't keep putting gas in the car, out on the highway. We've got to make sure that they can get to the next institutional financing.
Okay, so Jeff can put a small amount into lots.
Yeah,
far more than an average venture fund would do even. What's the strategy with Sandhill Angels? Do you try to pick winners every time, or do you?
Yeah.
What do you do?
Well, first of all, the way we have about 60 members, and everything from software guys to ex-Googlers to biotech, blah blah blah. So for any given deal, people have a choice of what deal they want to invest in. So we form an LLC so that there's a single investor, and so the cap sheets are nice and clean, so it's not a big mess and it's not hurting cats. But ultimately, an angel group is a group of individuals acting as individuals, and and there's turnover in these groups, right? So there's not the continuity. You don't have a 10-year fund lifetime. So they're ad hoc pledge funds, and you have to take that into account when you structure your investments and when you pick investments. So we don't have any kind of diversification plan. We pick deals that the membership likes, that we think they'll invest in, you know, as far as we being like the screening committee to go before the entire group. So basically we're looking for curb appeal, if you will. And, you know, because we're not really functional as an angel group if we're not actually making investments.
Right.
So it's basically driven by demand as opposed to any kind of formal diversification strategy. If that's the question that you were getting towards.
Yeah, okay. The other thing, I don't know if you're prepared to talk about it here, but I'll ask the question. What type of returns, what sort of business returns do you look for as this model? You put in this one shot and then you have to walk away from it. So you've got very high risk. Yeah. And it's a balance of the risk you're taking versus the reward you're
that's an incredibly complicated question. And you know, how do you measure risk? You know, do you look at IRR? When has the money really gone in? Blah blah blah. You know, our guidelines are these. When we put money into a company, we expect it to be VC fundable within 12 months, 18 at the outside. Okay. Anything beyond that, that's beyond our time horizon. So that's really critical. And so we want to see some sort of value inflection point within that time span that's going to be able to get the attention of, you know, a real institutional investor. You know, we're sub-institutional. And
so it's key that the money you've put in can get them to that critical milestone.
Absolutely. That's the fundamental point that determines whether we move forward with the deal. Yep. Everything else is negotiable. That's not, because, you know, that's we can't carry our deals.
Okay. Jeff, do you have any comment on that?
So I think we're very similar, where in most cases, the companies we fund will need another round. It's like very unusual that companies sort of get to sheer profitability, sustainability, and scale on, you know, a $1.5 million investment. It happens, in which case it's great, but most often what we do is help get the company to the next round. Okay. And that's our job, that's our role, and I agree with John, that's what we do. We sort of try and assess the probability, likelihood of that company to execute the right set of milestones and objectives to be fundable by VCs for the next round. In terms of returns, you know, I think that the expectation from my own investors, since I'm actually investing, you know, out of a fund that has raised money from institutionals and angels, is sort of typical VC returns, which would be like, you know, 3 to 4x, you know, cash on cash. Right. In terms of IRR, I think that it's less important to them given the small amount that has been invested. So I'm not really sort of focusing on the timing of cash flows per se, given that you don't know how long it's going to take for exits to happen. If you look at my personal portfolio, when I was an angel, I've had 5 exits, and the 5 exits happened anywhere from 6 months to 2.5 years. So relatively short sort of exits, or short-term frame exits. And those produced, you know, a pretty healthy return to myself. As to whether I can sort of provide the same, I hope, but we'll only see, you know, once we have real exit opportunities, because exit opportunities are sort of pretty much, I wouldn't say gone, you know, a couple of M&As have been announced over the past couple of weeks, which is great for the industry, but those were sort of small exits with small returns. You know, we'll take anything in this market, so even a small return is a good thing. But in order to sort of sustain the industry, which is really sort of one of the issues, we need, you know, the exit window to be really open and sort of really closed itself. IPOs are gone and exits have really sort of decreased in a major way, which means that we have, you know, a backup of exits, so to speak, in the portfolios, and we'll see how sort of those things sort of start happening again in a year or a year and a half. Okay,
we've only got a couple of minutes left, so just a pretty quick answer. I'm a Googler or a Microsoft or somebody else who's just been shown the door. I've got a few buddies, we're pretty smart people, we know what we're doing, and we have 3 options. I can go and scrabble about and try and get another job again. I can go and do that MBA I've been putting off for the last 5 years, or I can go and start that company I've been putting off for the last 5 years. What's your advice to those people, from both of you? Well, what would you do in the current climate?
I would say that it's, if you have the right team and you're all passionate and you're all ready to spend a year getting no salary and working on this product, on this idea, on this startup that you have, a passion for, then it's worth a shot. But you have to sort of be sure that there is a general commitment around the table, that you're all for it, and you're going to go through that sort of difficult time, because it's not easy to build a startup on fumes, and the money that might come one day will only be based on your ability to demonstrate and build something which is valuable, interesting, with a business model would be better. And it's pretty much a 6 months to a year commitment.
Right.
If you're ready and up for that, it's a good market. There are people sort of ready to back sort of experienced teams.
John, what's your view on that?
I agree. I think this is a good time to, if you can self-fund and you can take, essentially not draw a salary, and you have a real quality core team, this is a good time to assemble other really good team members that might not be able to be coaxed out of their comfy jobs. And, the times will get better, right? I mean, this is going to just be a bad memory in a year or so. Or two. I'm counting a year, but no, I think this is the time. If you have one more startup in you, this is probably the best time. It's tough. It's going to be tough to find a job, and it's easy to get really good people right now.
I'm getting the wrap-up signal here, so we've run through our time. John and Jeff, thank you both very much for your time, and thank you and goodbye from the Silicon Valley Entrepreneur, and look forward to seeing you again next month.